Look, let me describe a situation, and if this feels a little too familiar, just know you're not alone. You've got money sitting in your bank account. Not no money, like actual money. Maybe it's $5,000, maybe it's $20,000, maybe it's way more than that. And every time you open your banking app, part of you thinks, I should invest this. But not right now, because the market feels expensive, or the headlines are scary, or interest rates are high, or you're waiting for the pullback, or you're just not quite ready yet. So you wait, weeks turn into months turn into years, and the money just sits there. If that's you, if you've ever felt paralyzed by the fear of investing at the wrong time, then this video might quietly save you hundreds of thousands of dollars over your lifetime. And yeah, I know that sounds dramatic, but stick with me, because today I'm going to show you a rule most people have never heard of, the 66% rule, and why waiting to invest is usually the most expensive financial mistake people make. My name is Tom, and I spend way too much time thinking about investing, market timing, and why smart people keep making the same money mistakes. If you're someone who knows they should be investing but keeps waiting for the right moment, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Alright, let's talk about something that makes people deeply uncomfortable. Here's the thing, most people think waiting to invest is the safe option. It feels responsible, it feels cautious, it feels like you're being disciplined. But here's what most people don't realize, waiting is not neutral. Waiting is a decision, and statistically, historically, mathematically, it's usually the wrong one. And this is where the 66% rule comes in. The 66% rule is simple, but brutal. It says this: roughly 66% of the time, investing your money immediately beats waiting, even if you invest right before a market downturn. Let that sink in for a second. Not 90%, not always, but 2/3 of the time, the best move is to invest now, not later. And this isn't motivational fluff. This comes straight from decades of market data. So the obvious question is, how is that possible? How can investing before a crash still beat waiting? Let's walk through an example with real numbers. Say you have $10,000 ready to invest. You're deciding between two options. Option A, invest now. You invest the full $10,000 today into a broad market index fund. Option B, wait for a better entry. You keep the money in cash, earning maybe 4 or 5% in a high yield savings account while waiting for the market to drop. Sounds reasonable, right? Here's where things get uncomfortable. When people say, I'm waiting for the market to drop, what they mean is, I want to buy after prices go down, but before they go back up, which is cute, because that requires being right twice. You have to know when to get out, know when to get back in, and here's what decades of research show. Even professional investors, people who do this for a living, fail at this consistently. In fact, multiple studies show that missing just the 10 best days in the market over a 20-year period can cut your total returns by more than 50%. 10 days out of thousands. This is why timing is so dangerous. Now let's talk about the stat that makes people squirm. When researchers looked at rolling historical data, investing immediately versus waiting 3, 6, or 12 months, they found that about 2/3 of the time, investing right away produced higher long-term returns, even if the market dropped shortly after. Why? Because markets go up more often than they go down, and when they go up fast. Most market gains are concentrated in relatively short bursts. And if you're sitting in cash when that happens, you don't get a do-over. Think of investing like getting on a moving train. You're standing on the platform saying, I'll get on once it slows down. But most of the time, the train doesn't slow down, it just keeps moving. And the longer you wait, the harder it is to jump on without getting hurt. Let's say you do get lucky. You wait, and the market drops 20%. You feel like a genius. But here's the catch no one talks about. You're now waiting again, because it feels irresponsible to buy while things are still falling. So you wait for confirmation. And by the time that confirmation shows up, prices are already higher. This is why most people don't actually buy the dip. They buy after the dip. This is loss aversion. Humans feel losses about twice as strongly as gains. So the pain of investing right before a drop feels unbearable, even if mathematically it barely matters over time. Your brain is wired to avoid regret. But here's the cruel irony. Avoiding short-term regret creates long-term financial regret. Let me show you what this actually costs. If you invest $10,000 today and earn an average 8% return over 30 years, you end up with about $100,000. If you wait just 1 year, trying to time the market and miss some gains, that final number drops dramatically. And if you repeat that behavior over and over, waiting, hesitating, sitting in cash, you're not just losing returns, you're losing time, and time is the only thing money cannot replace. Now, you might be thinking, okay, Tom, but what if the market crashes right after I invest? Great question. Short answer, that happens. And it still usually doesn't matter, because if your time horizon is long enough, 10, 20, 30 years, short-term drops become statistical noise. Markets recover, compounding resumes, life moves on. But if you never invest, nothing compounds. The biggest risk isn't volatility. The biggest risk is never getting started. The 66% rule isn't saying markets only go up. It's saying waiting feels safe, but historically it costs more than it protects. So if you've been sitting on cash telling yourself, I'll invest when things feel clearer, I hate to break it to you, they never feel clear. There's always something to worry about, and that's exactly why the 66% rule exists. Alright, so now that we understand why waiting usually loses, let's talk about the part that makes people visibly uncomfortable, because once you accept the 66% rule, it leads to a conclusion most people really don't want to hear, and that is this: lump sum investing beats waiting or slowly easing in most of the time. And yeah, I know, even saying that out loud feels irresponsible. So let's break it down. Here's the setup most people face. You come into a chunk of money, a bonus, an inheritance, a business sale, years of savings, and you ask, should I invest it all now or spread it out over time? Emotionally, spreading it out feels safer, but historically, it loses about 2/3 of the time. That's the same 66% rule showing up again. Why? Because markets have a positive expected return, which is a fancy way of saying over time, markets tend to go up more than they go down. So delaying money from the market means delaying growth. Let's say you have $60,000 to invest. Option A, lump sum. You invest all $60,000 today. Option B, dollar cost average. You invest $5,000 per month over the next year. Now assume the market averages about 8% annually. If the market rises steadily, which it does more often than people think, the lump sum wins. Not because it's smarter, but because more money is working sooner. That's it. There's no magic, just time. Now, you might be thinking, okay, but what if I invest the lump sum and the market drops 30% next month? Totally fair fear, but here's what most people don't realize. If your time horizon is long enough, that drop barely matters. Let me explain why. When you invest for decades, your outcome is dominated by what happens later, not what happens right after you invest. Early volatility feels dramatic, but mathematically, it's small. Think about it like this. If your portfolio grows from $60,000 to $600,000 over time, that early $10,000 swing you were terrified of, it disappears in the noise. But delaying the investment, that permanently shrinks the base you compound from. This is where psychology sneaks in. Humans prefer emotional safety over statistical advantage. Waiting feels safe. Spreading money out feels responsible. Cash feels calm, but calm doesn't compound. And the market doesn't reward comfort. It rewards participation. Here's another uncomfortable truth. The news is designed to make you wait. Markets going up slowly, boring. No clicks, markets crashing, front page. So your brain gets trained to associate investing with danger, even though the danger is often overstated. If waiting were actually smart, we'd see it show up in data, but instead, we see the opposite. Study after study shows that the average investor earns significantly less than the market itself. Not because they pick bad investments, but because they wait too long, panic sell, hesitate to re-enter. In other words, they follow their emotions instead of math. People talk about the perfect time to invest like it's a real thing. It's not. The perfect entry point is usually only obvious in hindsight, and by the time it feels safe, the opportunity is gone. Think back to a time when the market dropped. Everyone was scared. You were watching from the sidelines. You told yourself, I'll invest once things stabilize. Then suddenly, prices were higher. Confidence returned, and you felt like you missed it. That cycle repeats again and again, and the 66% rule explains why. Now look, I'm not here to bully you into lump sum investing if it genuinely keeps you up at night, because stress matters. So here's the compromise strategy. Here's what you do. Invest 50% immediately. Invest the remaining 50% over the next 3 to 6 months. This does two things. Gets a meaningful amount of money working now. Reduces regret if the market drops short term. Is it mathematically optimal? No. Is it emotionally sustainable? For many people, yes, and consistency beats optimization. The biggest enemy of investing isn't bad timing, it's never committing. If a strategy helps you stay invested, it's a good strategy. So let's pause. If you're watching this and thinking, okay, I get it, waiting is hurting me. That's good because awareness is step one, but understanding doesn't change your financial future. Action does. And that's where we're going next. All right. At this point, you understand the math, you understand the psychology, you understand why waiting feels smart, but usually isn't. So now the only question left is, what do you actually do with this information? Because insight without action is just entertainment, and I don't want this to be another video you nod along to. Then close the app and change nothing. Before you invest a single dollar, you need to answer one question honestly. When will I need this money? If the answer is within the next 3 years, this is not investing money 5+ years from now. This is exactly what markets are for. The 66% rule only works if time is on your side. Time is the shock absorber. Without it, volatility hurts. Here's a mistake I see all the time. People hesitate to invest because they're secretly afraid they'll need the money. That's not a market problem. That's a planning problem. Before investing, keep 3 to 6 months of expenses in cash. Put it somewhere boring and accessible. Never touch it for investing. Once that's done, your investing money no longer needs to be safe. It needs to be productive. This is where most people spiral, so we're going to make it boring. Choose one of these. Option 1, lump sum, invest everything now and don't look back. Option 2, half now, half soon, 50%. Today, 50% spread evenly over the next 3 to 6 months. Then, and this part matters, write it down, because once emotions show up, logic disappears. If your investing plan requires motivation, it will fail. Automation removes emotion. Set, automatic contributions, automatic purchases, automatic rebalancing. The less often you have to decide, the better your results will be. This is how normal people beat their own instincts. Here's what most people don't realize. Successful investors don't think in terms of prices. They think in terms of ownership. When the market drops, you don't lose money. You temporarily own assets priced lower than before. That's it. If you wouldn't panic because your house got appraised lower this year, why panic about stocks? This part is important. Every day you don't invest, you are choosing lower future options, less flexibility, more years of work, not because you're lazy, but because fear is sneaky. And the 66% rule exposes that fear for what it is, a costly illusion of safety. I've talked to people in their 50s and 60s who say, I wish I had started earlier. I have never, not once, heard someone say, I'm glad I waited so long to invest. That regret compounds too. This isn't about beating the market. It's about getting out of your own way. It's about accepting that. Uncertainty never goes away, clarity never arrives, and waiting rarely pays. The people who build wealth aren't braver, they just act sooner. Here's what I want you to do after this video ends. Decide whether your money is investing money or not. Choose your entry strategy, set the first transaction, walk away. That's it. No monitoring, no tweaking, no refreshing apps every 10 minutes. Let compounding do its job. The market will scare you again. Headlines will panic you again. Your brain will tell you to wait again. And when that happens, remember this. 2/3 of the time, waiting is the mistake. The 66% rule doesn't guarantee profits. It guarantees honesty. If this helped you rethink how you approach investing, hit the thumbs up. It genuinely helps more people see this. Subscribe if you want clear, no-nonsense explanations about money without the hype. And if you've been waiting to invest, maybe today's the day you stop waiting. I'll see you in the next one.